This is the Friday, October 27th, 2017 version of the Market Plus segment. Joining us now is Ted Seifried. Ted, welcome back.
Hey, thanks for having me, Mike.
Well, we're glad to have you. We apologize. We did not get a chance to discuss cotton on the program. Up $1.32 on the week.
Yeah.
Kind of a bounce off the bottom of that range, isn't it?
Yes, that's exactly what it was.
Okay.
From my perspective, we found support and profit taking for the most part.
Okay.
So it was a nice bounce, and it might be suggesting that, okay, we're just going to continue to hold this range for now. But it was a good bounce. It was fun to watch.
It was. And I imagine the USDA is probably going to make some changes again to the cotton crop. Do we ever anticipate them to incorporate the damage from Irma and Harvey and all these other hurricanes?
Yeah, and I think we will see that. But the problem is you look at the world balance sheet for cotton, and it's pretty robust. So if we lose some of our production here, it's just not, in my opinion, going to make that big of a difference to really make cotton prices go sharply higher. Now, here domestically, if we started seeing quite a bit more demand, especially from China, that export demand, that would maybe change things a bit. But for now, I think it was more of a technical bounce than anything else.
Okay. Well, now let's get into our questions here from our followers on Twitter and on Facebook. Our first one comes from Robert in Sanborn, New York. Thank you, Robert, for tuning into Market to Market. He's there at Real Bob Mills on Twitter. He says, hard red wheat acres, planted acres are down again this fall. Will this matter anything to the market?
Well, Robert, that's a great question. Thank you. The answer to that is yes, at some point. Is it now? I don't know. Look at what happened with our spring wheat crop, and while we did have a flash in the pan rally there, it's just not able to really hold on to or resume any sort of that strength. Again, world wheat numbers are just so large right now, and we're trying to, and we're, I'd say, more than halfway through the process of, at least in this country, cutting back production fairly aggressively on wheat. And at some point, that will make a difference on our domestic market, even if we're not seeing huge exports. So yes, it will at some point. I don't know if this is the year, though.
Okay, all right. We need the rest of the world to
that's the main
cut
problem.
down their acreage. All right, our next question comes from Jeremy in Lanark, Illinois, on Twitter at jflickema. Thank you, Jeremy. Jeremy asks, why do we have to believe that the funds will leave the equities and come to commodities?
That's a good question, Jeremy. Why do we have to believe that the funds will leave equities and come to commodities?
And let's unpack it a little bit. What's the probability that in the next, before January 1, funds are going to leave equities?
Okay, so that's a different question, but that's more of a forecasting question on what I think equities are going to do, right? But to get to Jeremy's question, and then to that, the relationship that equities and commodities have, right? If there's a market, like the equities have been for so long, that's just very gracefully trending higher without too many hiccups, a lot of the speculative money wants to go there because it considers it a safe way of building revenue, right? So if that continues to happen, then a lot of the speculative money likes to play on that side of things. If there starts to become a lot more volatility in the equities markets, you'll have investors wanting to get out of that and look for something else. And in particular, they'll look for commodities that are near 5-year lows, for example, and corn and wheat are good ones for that. So, that's the relationship that we have there. Now, there's lots of different types of funds. Now, there's other funds that are just strictly commodity funds, and they're always rebalancing their portfolio on how much of one commodity they have in it or not, but they're usually in most of the bigger commodities. We talked about on the program that funds are, in my opinion, or in my analysis, either at or very close to record short in corn and also wheat. So those funds, they're in the market.
Right.
They're just short.
Yeah.
Right. And the fact that they are short, it kind of makes a bit of a powder keg because if something happens to get them out of the markets, then there's a lot of buying potential there. And I like it better that the funds are at record shorts now because records are made to be broken. They can increase that, but they're not halfway to the record. They're not going to double their short position at this point, at least. Most likely.
Right. It would have to be some very, very bearish news to get them to double their short position.
Absolutely. So I guess that's the best way I can answer the question about the relationship between the funds and commodities and equities. Now, to your question, there are a lot of things happening on both domestically and globally, that could cause more uncertainty for the equity markets going forward. Raising rates is part of that, and as we said, right now the market's not really anticipating much in the way of rate hikes in the first, well, probably 2 quarters of next year. If that were to start happening, that would probably put a damper on the U.S. Stock market. Again, all the different conflicts that we have going on all over the world, if something were to heat up with that, especially if we're involved, again, North Korea being probably most likely. Any of these things, can put a lot of pressure on the stock market. And we've started to see a little bit of signs, even this week, that, okay, maybe there is going to be some more volatility creeping back into this market. So we'll see. I've many times thought that, okay, we're overvalued in the stock market, and we should be in for a deeper correction at some time in the relatively near future, and that's never happened. So I've gotten tired of and have completely stopped making bets against the stock market at this point. But if we were to see something like that, then yes, absolutely, you could see a lot of the speculative money that is absent from commodities right now come in and start wanting to own commodities, specifically the ones that are down near their lows or 5-year average lows.
The value-priced commodities.
The value-priced commodities, yes.
Well, now, Jeremy has a second question for us. Yeah, Jeremy, thank you very much, Jeremy. Jeremy wants to know, can we believe past year price performance will be a template for this upcoming year? And he says, as an example, we've got ample supply and demand structure. I mean,
the disclaimers are always, past performance is not indicative of future performance. Okay, to some extent, though, I think you do. You look at the last 3 years and the way we've traded. Last year, we didn't put a whole lot of weather premium in for the U.S. growing season because we had ample supplies, and we've had a couple of years here where we've had a little bit of scares, but at the end, yields come out very well. I think that could be a similar situation for this year, where we don't really pump a whole lot of weather premium into the market in spring. So that's a concern. I don't like that. And then, you look at spread trade. That's for the last few years have been showing ample supply up front and really encouraging carry. I think this right now is probably one of the widest we've seen with that. So that's just a reflection of the times, and I think that holds true unless something changes. So yeah, I do think that there's a pretty good template from the last couple of years to apply to this year. But that's the thing. I mean, we trade futures, not today's, right?
Right.
Something can always happen. I know there was one of my friends who was talking last week about the possibility of China coming back in for U.S. corn because a big chunk of their reserves, actually sounds like the vast majority of the reserves, can't really be used for much of anything.
Quality is a major concern.
Extreme concern.
Yeah.
And with their push to want to really move towards corn-based ethanol in a much bigger way, well, who's going to fill that? Now, they have relationships with the Ukraine, and that's been their main thing, and then also South America. And with our trade relations, I think they're going to try to avoid us. But I don't know if they're going to be able to fill all of their needs. So that's a possibility. That's something that could come down the road. Here, our ethanol situation seems to be taking a turn where, EPA wanted to kind of taper off the RFS mandates, but now Trump's sort of pushing back on that. So that could be a longer-term positive. But I don't know if we're going to see like a real big spark that's really going to change these markets from the sort of pattern that we've been seeing in the last 3 years. But that's the point. We don't know. That's why they're futures.
Exactly. That's where there's risk, there's reward sometimes. Now, Ted, before we let you go, we mentioned on the program crude oil has been in I guess you'd call it an uptrend. I mean, we put $4 in here over the past 2 weeks. Is crude now, is 50 our floor?
Ooh, I don't think indefinitely 50 is our floor. No, you look at the Permian, the crude oil fundamentals, supply fundamentals of crude oil are much better than what we thought years ago.
Meaning we've got ample supply.
Yes.
It's like the grains.
Yes, absolutely. But here's the thing, crude in the 60s for me brings on too much production here in the U.S. So I don't know how much further this uptrend is going to go. But here this week even, you had the Saudi oil minister saying that they're going to do whatever it takes to get stocks back down to 5-year averages. And then that followed up a day or two later by the Saudi prince saying that he's backing the idea of extending cuts through the end of 2018. So that has worked so far. If that's going to continue on, I think we've got a floor underneath us. I don't know if it's $50, but I think it's closer to maybe $40.
Okay.
But it's going to keep some support underneath the market. Now, U.S. exports have been the strongest we've ever seen. You start pushing that dollar higher again, our domestic stocks start to grow. So, again, just reasons why 50 might not be the floor. But for the time being, and the way we ended the week on Friday, it does look like we're going to continue to be in an uptrend. And the main concern is, what OPEC's doing and their plans for continuing to freeze production.
All right. Well, Ted Seifried, thank you so much for taking the time to talk to us this week.
Always a pleasure, bud.
We enjoy it. Now, folks, our drought continues for your questions on the basics of trading or trends in the marketplace. So join in, send us your questions in video form. We'll teach you how to do that. Just direct message us on Twitter or send an email to markettomarket@iptv.org for details. So, Ted, thanks again for joining us. And folks, join us again next week when we'll look at a new apple that may revolutionize the orchard, and Naomi Bloom will sit across from me at the Market to Market table. Until then, thanks for watching or listening. I'm Mike Pearson. Have a great week.